Welcome to The Explainer. Today, we're unpacking a highly specific rule that literally flips the script on buying a home. If you've ever gone through a real estate transaction, you know the drill, right? It's usually a sea of variables, endless negotiations, and a million optional add-ons. But today, we're looking at the exact opposite. We're talking about a mandatory insurance policy required for all potential home buyers who are working with Nationwide Real Estate Acquisitions, LLC. We're going to break down exactly how this policy is structured, who it actually helps, and the mechanics of how it acts as an absolute safety net. Let's jump right into the source text and see how this organization sets the baseline for its buyers.
You really have to notice the incredibly strict language they use right out of the gate, non-negotiable requirement. I mean, in the real estate world, almost everything feels like a negotiation. You haggle over the price, the closing costs, you ask for repair credits, the whole shebang. But Nationwide Real Estate Acquisitions, LLC, they draw an absolute hard line in the sand. This is not a suggestion. It's not some premium tier you can just opt into if you're feeling a little cautious. It is a completely mandatory rule for completing a purchase through them. By making this non-negotiable, the company is effectively saying, look, the transaction simply cannot and will not proceed without this specific layer of security in place. It builds a total foundation of certainty before the keys ever even change hands.
And here's the kicker. That certainty is locked in for a very specific duration. Exactly 15 years. Every single potential buyer is explicitly required to purchase and maintain this mortgage protection policy for a decade and a half. So we're not talking about a short-term band-aid just to get you through the, vulnerable first year or two of homeownership. And it's not a lifetime burden either. A 15-year window covers a massive chunk of a standard mortgage's life. It's a highly calculated span of time. It's the period when a buyer is systematically paying down their principal, but it's also the exact window where a sudden financial shock could be the most devastating. By enforcing this 15-year requirement, the policy basically guarantees stability for a truly critical period of the loan.
Now, to really understand why a company would enforce such a strict timeline, we have to look at how they actually classify the rule. The text specifically defines this requirement as a risk mitigation control. And I want you to really focus on that phrase for a second. It frames this mandatory insurance not as a hurdle or some annoying extra fee or a barrier to entry. No, it's a heavily calculated financial safety mechanism. Risk mitigation is all about identifying those worst-case scenarios and engineering a system to neutralize them before they ever happen. When you're dealing with hundreds of thousands of dollars and people's actual livelihoods, well, just hoping for the best is not a strategy. This risk mitigation control is the strategy. It's designed specifically to protect all parties from extreme hardship.
So how does this actually play out in real life, like in a true win-win scenario? Well, the primary immediate benefit goes directly to the home buyer. It absolutely protects them from the devastating outcome of losing their property. Homeownership is usually the absolute bedrock of a person's financial stability and personal security, right? Losing a home isn't just a tough financial hit, it is a deeply, deeply traumatic life event. This mandatory policy acts as a literal shield against that exact trauma. The buyer knows that even if the ground totally falls out from under them, the roof is going to stay over their head.
But let's be real, what actually causes the ground to fall out from under someone? The source text is crystal clear on the exact triggers. This policy acts as a safety net, specifically if the buyer faces unemployment, disability, or accidental death. These are the big three. The major, unpredictable life events that immediately sever a person's ability to generate income and, pay a mortgage. You can't plan for a random accident. You can't predict a sudden disabling health crisis. And sudden unemployment? That can happen regardless of how hard you work. By explicitly covering these three catastrophic events, this risk mitigation control targets the exact, specific vulnerabilities that most commonly lead to people losing their homes.
Okay, so that covers the buyer. But how does this build the second half of that win-win scenario we talked about? Well, the source text explicitly highlights the for sale by owner home seller. Think about it. If an owner is carrying the note themselves, or if they're deeply invested in the transaction's success, a buyer defaulting is literally a nightmare. The seller would be forced to navigate the massive, incredibly expensive, and legally complex burden of having to foreclose on the property, all because the buyer couldn't make the mortgage payments anymore. This 15-year policy completely protects the seller from ever having to go through that grueling process. So while the buyer gets to keep their home during a crisis, the seller is simultaneously protected from the massive financial and emotional toll of foreclosure. It's a completely closed loop of shared security.
To wrap up our explainer today, we really have to reflect on this big question. By enforcing a strict 15-year insurance requirement, does this kind of shared risk mitigation control fundamentally eliminate the worst-case scenario for everyone involved? I mean, we've seen how a non-negotiable policy targets the specific terrifying realities of unemployment, disability, and accidental death. And we've seen how it completely insulates both sides of a forced sale by owner transaction, legally and financially. It really forces us to ask, should mandatory protection mechanisms like this become the standard across all of real estate? It's an absolutely fascinating approach to financial security, and one that is for sure going to change the way we think about the risks of buying and selling a home.